For nearly 3 decades, Japan's economy was famously stuck in a deep freeze. Prices didn't go up, wages didn't grow, and the central bank literally had to set interest rates below zero just to get people to spend money. But right now, Japan is making one of the most drastic economic pivots in modern history. The Bank of Japan has officially killed off its ultra-loose monetary policy, pushing interest rates up to 1.0%, its highest level since 1995. So why is a tiny percentage change making massive headlines across the financial world? And is Japan's big gamble about to pay off or blow up in their faces? Let's break it down. To understand why this is a huge deal, we have to look back at the 1990s. After Japan's asset bubble burst, the country entered an era known as the Lost Decades. Japan suffered from chronic deflation. Consumers delayed buying things because they expected prices to drop tomorrow, which starved businesses of profits and froze wages. To battle this, the Bank of Japan did something radical. They made borrowing money practically free, and at one point charged banks to hold cash via negative interest rates. Fast forward to today, the script has flipped. Thanks to global supply chain shifts, rising energy costs, and historic wage hikes from annual negotiations known as shunto, wages jumped over 5%. Inflation stabilized right in the sweet spot between 1.7% and 2.5%. For the first time in a generation, Japan isn't fighting falling prices, it's managing normal economic growth. Proponents of this move argue that Japan is finally breaking free from its economic ghost town status. First, it protects the Japanese yen. When Japan kept interest rates at zero while the rest of the world hiked theirs, the yen plummeted in value. That made importing food, fuel, and raw materials painfully expensive for local households. Raising rates helps shore up the yen and restores purchasing power. Second, it encourages innovation. For years, ultra-cheap credit kept weak, unproductive companies alive on life support, so-called zombie firms. Higher borrowing costs force companies to modernize. Faced with a severe labor shortage due to an aging population, Japanese firms are now pouring billions into AI, advanced robotics, and automation, while gradually opening doors to more foreign talent. Third, it rebuilds consumer confidence. When workers see their paychecks growing faster than inflation, they actually spend money, creating a healthy cycle that powers the entire economy. However, critics warn that Japan is playing with fire and the risks aren't just local, they're global. The biggest threat? Japan's terrifying debt pile. Japan's government debt to GDP ratio sits at over 250%, at the highest among all G7 nations. When interest rates were zero, servicing that debt was manageable. But at higher interest rates, the interest payments alone threaten to consume a massive chunk of the national budget. Then there's the global fallout from the yen carry trade. For decades, hedge funds and investors borrowed cheap yen at nearly 0% interest and dumped that money into higher-yielding assets worldwide, like US tech stocks or high-yield bonds. Now that Japanese rates are rising and the yen is strengthening, those investors are forced to unwind those trades and pay back their loans. This sudden shift of capital can trigger massive volatility and sell-offs in global stock markets. Finally, at home, an entire generation of young Japanese home buyers and small business owners have never experienced interest rates above zero. Rising mortgage rates and tighter business loans could hit local pockets hard. Japan stands at a critical crossroads. On one hand, normalizing its economy offers a path back to sustainable wealth, tech innovation, and rising wages. On the other, balancing a massive debt mountain with global market ripples makes this one of the riskiest economic maneuvers of our time. Will Japan successfully engineer a smooth landing and solidify its place as a modernized economic power, or are we witnessing the start of a whole new financial storm? What do y'all think? Is Japan's central bank making a brilliant move or setting off a financial time bomb? Drop your thoughts in the comments below.